And welcome back to Arise Exchange. It could be the end of gold's golden era. Today, gold prices plunged to a 34-month low to just over $1,200 an ounce on the COMEX spot gold market. To be clear, last summer, gold was trading at an all-time high of $1,900 an ounce. How far could it fall? Well, once was just a few $100s. Now investors are retreating ahead more fears that the Fed could start tapering its economic stimulus. And gold, by the way, isn't the only market getting hammered. Ever since May 22nd, when Fed Chair Ben Bernanke hinted that he would begin scaling back the bond buying program, all asset classes have taken a hit. To talk more now about the collapse in gold prices and what's going on in the markets is Jim Barksdale. He's the founder of Equity Investment Corporation, which tends to be a value investor. Welcome to the program.
Thank you, Andrew. Glad to be here.
Let's start with gold. What is going on? Because if this is a safe haven and you have market turmoil and the dollar's been strengthening, I guess, a little bit, why is gold in such a sell-off? Was it just so overbought?
Well, let me first just sort of say that, we're long-term investors. Yes. We're not gold experts. But I think
and you're value investors. You look at the values.
The narrative you just put forward in terms of the rise in high gold prices a year ago versus the decline today bespeaks of one of the most important things that investors need to always remember, which is always underbet your beliefs. Mm-hmm. No matter how compelling the narrative on the upside was or how compelling the narrative is on the downside now for gold, the truth is the future can look very different than those compelling narratives. So always underbet your beliefs. So with respect to the gold price changes that we've had, the real world economy is one that continues to be slow. Commodity prices are down, China's weak, Europe's weak, and the Fed is going to continue to have to try to slay those dragons. But in the meantime, it had to slay another dragon, which was that the asset bubble was getting a little bit ahead of itself. And so in order to do that, it's indicated that it's going to perhaps taper.
So you're a value investor and you're a long-term investor, which is very important here because you still have to kind of deal with the gyrations of the market, but you have a little bit of a longer-term view. So let's go out now 6, 9, maybe 6, 9 months and maybe a year. Do you see the Fed with the current economic numbers having to keep the stimulus longer?
Yes, I think that's right, because of the weakness. And so what you've seen is the speculators getting ahead of the curve as much as they can. It's like when you're retreating off the battlefield and you're trying to get your troops off the field, well, the enemy comes and attacks you and exploits it. And that's kind of what's happened. The speculators have come and attacked them, and that's what you've seen with the spike in interest rates and with the crash in the gold price. It's like, okay, if they're not going to be putting this money out there, let's get ahead of that by moving it so as fast as we can. And you've seen that both with the rise in the bond yields and with the collapse in gold prices.
Has Ben Bernanke been running off his mouth too much for somebody who's supposed to be kind of quiet and reserved? He's been saying a lot, possibly to catch up to the other things he said.
Well, I think these things should be more conditions-based as opposed to timetables. We don't want to get out by a certain date, but I think the reality is they probably did get a little ahead of themselves in a counterproductive way in saying some things with respect to the tapering. But the reality is he was dealing with a problem, and to a certain extent, he's successfully dealt with that problem. That is, the speculators can't rule the roost, so to speak, and the asset bubble was existing.
And the Fed is not for speculative investors. It's not supposed to be managing the stock market, which people should remember. As a value investor, then, where do you think we should be putting our money right now?
Well, we typically are pulled into the areas that people don't want to be in as much. That's typically where prices are more depressed with a quality hat on. So we've been over-allocating to the healthcare arena. We've over-allocated to some of the financials and banks, particularly because people were once burned, twice shy, and yet we've had a number of years of healing in the banking sector. So those are the two areas.
When you talk about banks, is it the community banks, or are you talking about the too big to fail banks?
Well, not the too big to fail ones. Those are the ones most exposed to the various, let's call it, if things run the other way. And so we've tried to stay with the safer banks, whether it's Wells Fargo, UBS, US Bancorp, and PNC Financial.
So banks, health, some financials, technology at all?
We've had some technology, but again, the safer technology ones, we've had Microsoft. Again, there's a lot of controversy about it.
400, I have to ask you, is it about time to get back in Apple?
Well, Apple is one that is priced for a decline in earnings, and you have to ask yourself, is that rational for earnings at a company like Apple to decline? And in the past battle that you had between a closed and open environment, Microsoft back 20 years ago, Apple 20 years ago, the open environment won. So this is the attack that's going against Apple's closed environment. So it may be a rational pricing that earnings are going to decline at this closed environment of Apple because there's so many people attacking it.
Jim, thank you so much. Jim Barksdale, welcome to the program. Hope to have you back soon from Equity Investment. You are watching Arise Exchange.